All right. Welcome, everybody, to Finance 444. My name is David Shipley. I'm the professor for this course and look forward to this course. Uh, Maybe not all of you share that opinion at this point. Hopefully, by the time we are done, I will have convinced you that there's some important material within the content here and that you'll be able to step away with some applicable information that you can actually apply to your lives and look forward to the things that you can use from this course going forward with your retirement planning, with the things that you're doing from an investment standpoint. Some of you are saying, hey, I don't have any investments, and my response to that would be, that's okay. We're going to talk about some different things that I hope that you will have. Some of you will have these things the moment that you get done with your degree. You're going to find an opportunity or career advancement that's going to place you in a situation where you'll have, maybe for the first time, a 401k or a simple IRA or some kind of pension through work, or maybe even just the income that affords you the ability to start contributing to an IRA or start investing. And so the content that we'll cover should be content that you should be able to use the rest of your lives, even if you don't invest or don't ever want to invest in the market for whatever your personal reasons might be. Any company that you work for is materially impacted by investments, by stocks, by the market, by the economy. And so some of these principles, even if you don't ever invest, will be applicable to the companies that you work for. And the more you know about those things, the more that management can appreciate your perspective and experience, and you can be very helpful. So a little bit about me. I work as my day job at Zions Bank as a financial advisor for customers of the bank. So I help them with financial planning and with investments and strategy. Try to help them lower their tax bills sometimes, help them with estate planning sometimes, help them with different complex investment products. Sometimes it's just very simple. I'm just trying to help them get a little bit more interest on their deposits. So something that I've done for the last 15 years, although only the last 3 years with Zions Bank. I've been at Northwestern Mutual, JP Morgan Chase Bank before that, but all in here in Utah. I was born in Idaho, but moved here to come to Utah State. And then I think I mentioned as much on the page, but after I got a master's degree in financial services about 10 years later, and only just a few years ago, I ended up completing an MBA through Independence U. So I'm very, very familiar with the format of taking courses online. This is well over 100 courses that I've taught through this online format. I've been teaching for the last 7 years, almost nonstop. So almost every single month I've had a course or courses that I've been teaching. And so a lot of different experiences that hopefully will help me to have to be able to look for ways to help you guys out. I understand that all of you are just anxious to get through this class, to pass it, to get an A, whatever your goal is, move on to the next thing. And it's part of a bigger plan, right, to get to the end of your degree. And so whatever I can do to help you along the way and just get you through this course the way that you're hoping to get through this course, that's my goal. If you want to communicate that to me, hey, I want an A in this class, what do I need to do? I'd welcome those kinds of conversations. Hey, I just want to pass this class. What's the minimum I have to do to get through it? Welcome that conversation. That's fine. There's no shame in that. So some basics on the expectations. Now, this is a Finance 444 class, so most all of you have heard basic expectations from different professors at this point. But I always have to do a little bit of a plug about plagiarism because for whatever reason, well, not for whatever reason, there's just a significant draw to plagiarizing when it comes to online courses. Somebody doesn't watch you do your work, and so you're able to go online and just pick off other people's work if you choose to. The school is very anxious to try to stop that, to try to curtail that, to try to punish people for doing that. And it's not because we want to be punitive. It's not because we want you to fail. It's because we want you to actually think through the content that we're trying to educate on, right? It defeats the purpose of getting an education if you're not learning anything. And the way that you learn in a course like this is that you try to form, you do research, right? You go find other people's opinions, but then you try to form your own opinions and you try to have your own perspective on things. And the more you process through things, and that's why we have discussion boards, is so that you can write about your opinions and thoughts instead of just regurgitating somebody else's information or memorization that you were forced to do. So if you hear from me, hey, great job on this, make sure that I hear more of your own opinions and perspective, more of your own thoughts. Don't be offended by that. Just know that I'm trying to help you to think through and process a little bit more, so that you can learn, and so that you can have more takeaways, and so that it can be something that hits, internally a little bit more, instead of just another thing that you have to do, right? Another tedious task. This course could be a lot more than that. There's a lot of great information that you could take with you and apply to your lives. And I'm anxious to try to encourage that, right? Doesn't mean you have to internalize it, but I at least want to give us a fair shot at that, which means that I need you to if you look at other people's work, right, which I expect you to, I expect you to do research, I also expect you to reference it. Do not use other people's work. Do not cut and paste anybody's work without referencing who you're taking information from, or where you're taking information from. And then beyond that, just know that my focus for a class like this is not other people's works. I want you to spend time thinking and processing through other people's information to form your own opinions and make sure and share those. So on an assignment, on a discussion board, I want it to be clear that I want you to demonstrate that you've thought this through, and that you have some of your own perspectives and opinions about it. You're not ever going to be wrong in this class or get discounted as far as your score if I disagree with your opinion. What you will get discounted for is if I don't see an opinion, right? If I don't see any thoughts or perspectives or experiences or anything that you've tried to come up with on your own, as opposed to just taking information from other places. But at a minimum, if you are going to take information from other places, which we know we have to do research in a class like this, when you do, make sure that you're referencing who did the work, who did the research, who gave that opinion, so that we don't have to have a conversation at some point about plagiarism. You get one warning and then you get an F in the class if you get that warning and then continue to plagiarize. So not a pretty thing. It's not a conversation I want to have with any of you. If you have any questions about what is or what isn't plagiarism, there's a little bit of information on, I know, the school's site, but also I'd be happy to have that discussion with you as well. And don't be afraid to have that conversation if you legitimately don't know for sure, whether or not it would be plagiarism or not to use somebody else's work in a certain setting. Okay, but default on the side of always credit, somebody else for opinions and perspective and information that's not yours. And then secondly, default on the side of forming your own opinions and own information more often than using other people's information. Okay, so a little bit about that. As far as minimum expectations, obviously we're going to have some consistent things with other classes that you've taken. First of all, in a class like this, you've got checkpoints, right? Worth a couple letter grades if you do them all. Worth a half a letter grade of extra credit if you're really consistent about your checkpoints. So a lot of people will ask about extra credit. My response is, hey, you've got a lot of opportunities if you'll stay diligent and consistent with the checkpoints. You've got as much of as a half a letter grade of extra credit if you'll just be consistent with those checkpoints. So want you to do checkpoints. They're easy points, one of the easiest ways you can get points in a class like this. And in addition to that, it gives you a buffer of extra credit points as well. As far as discussion boards, another really easy way to get points, but also one that takes some consistency and some diligence. We're going to have weeks where the normal requirement is that you've got to have a post in by Wednesday at midnight, right? The main post. And then you're going to have 2 more posts that are due by the end of the week, for a total of 3 posts each week. If you complete all those and follow the instructions, and it's basically the content requirement, meaning 2 to 3 paragraphs on the main post and at least 1 to 2 references. And then on the responses, that they're substantive. They're not just, hey, great job. Sometimes I give a short response because I'm giving a lot of responses, right? But for you, you can give short responses, but just make sure you've got 2 substantive responses to your peers, more than just, hey, great job, but this is my thought on it. This is my opinion on it. This is how I agree or disagree with what you said. And we do it in a polite and respectful way, and it works out great because more of us are thinking through the actual content. Again, internalizing what it is that we're trying to think about. That's the reason discussion boards are always required on online courses, because we're not in a class environment where you can ask questions and we can have dialogue with each other openly, right, in a class. We can't separate into groups and have open dialogue. So the way that we try to accomplish some open dialogue and some processing, some thoughtfulness about the content is these discussion boards. So I want you to demonstrate that thoughtfulness when it comes to your peers, right? Coming up with opinions and perspective and experiences and trying to interact with each other in a way that's constructive and thoughtful. So that should be demonstrated through your responses. But of course, your main post, you're just going to be following the instructions associated with that week, making sure that you fulfill all the requirements and questions that the instructions are asking for, and then you'll get full credit. Okay, so if we got those 3 posts and you meet the deadlines and you meet the content requirement and you're sharing your opinions and you're doing a great job, you're going to get full credit. I don't try to dock points. I try to give you as many points as I possibly can as an instructor. And so if you'll just follow the instructions and turn things in on time, you'll find yourself getting full credit most of the time. As far as assignments, we're going to have an assignment every week. This week is a paper on fundamental analysis. Okay, there's a lot of content out there on qualitative and quantitative fundamental analysis. So we're going to spend a little bit of time tonight on it, but not a lot, because there's a lot of good content out there, and I'm excited for you guys to go and find out more about that topic. Fundamental analysis is also a skill set that, again, even if you're not going to be an investor per se of stocks, bonds, mutual funds, something like that, fundamental analysis is something that can tie over into your research when it comes to which company to work for. Whether or not a company should merge with another or buy out another company, whether or not you should be self-employed, whether or not you should buy another company if you are self-employed. So fundamental analysis can bleed into other areas of our lives, not just investing. And so I think it's a great exercise, and that's what the assignment is this week. Sorry, back to the discussion board. The discussion board is on risk and reward, or the risk-reward trade-off, which is one of the most fundamental and important concepts of investing. So I'm excited for you to kind of dig into that a little bit. We'll talk a little bit about it tonight, but not really, kind of just on the surface, because I really want you to think through what it really means to have a risk-reward trade-off and why that's so important to how we invest and why we invest. Okay, so we talked a little bit about the discussion board and also specifically what it is for this week, what it means for this week. We also talked about the expectations for the assignment. It's due at the end of the week. There's a word number requirement. I don't count words. I'll just tell you that right now. But if it's obviously shorter than it should be, then I have to dock credit, right? There's a reason that word requirement is there, but I'm not going to be so specific that if you're a word or two short that somehow you're going to not get full credit. If you've done a great job and fulfilled the assignment and instructions, if you're a few words short, that's fine. That's not opening the door for you to be 100 or 200 or 300 words short and still expect to get full credit. So just keep that in mind. Try to get as close as you can to the word count. Go over if you want to be safe. And just know that if you are under the word count, you leave yourself open to give a few points up on the table. As far as assignments, a lot of people will ask, do I accept late assignments, late posts, late work in a class like this? And the answer is yes. I will accept late work. I will accept late discussions, assignments, assessments, all the way up until the end of the class, which is in 4 weeks on a Saturday night at midnight. The school policy is that I can't accept work beyond that point. But what I would tell you as just kind of a voice of warning is, having done this for a lot of years, the consistent thing in classes like this is that if you procrastinate and you allow yourself to wait until that last day, sometimes you'll be fine. You'll get what you need done. You'll get discounted because you were late, but you'll still pass the class. But many times, life will get in the way. A health issue will come up, a work issue will come up, a family issue will come up, something, a computer, connectivity issue will come up. There's all kinds of different things that life will throw at you. And if you've procrastinated and if you've waited until the last minute to turn things in, it tends to be that time that things come up and prevent you from getting your work in. And then I can't pass you. I have to see the majority of your work get turned in and the majority of the instructions get followed, or you're not going to get a passing grade. And especially if you're trying to get an A from the class, stay caught up, right? Stay on time. But just know that, the late policy is more for a situation where you just have a really, really tough week or a tough weekend, a family emergency, a health issue, a crisis of some kind, a move. And so you're a day or two late. It's not for somebody to say, okay, I don't have to do anything until the last week and then I'm going to turn it all in. Okay. The longer it goes, the more of a discount I give as far as your score, so just keep that in mind as well. And like I say, if you're trying to get an A from the class, turning everything in late is not going to work. It may work to pass the class if you turn everything in late, but again, you run the risk of, life coming up, you're running out of time and not being able to pass, which is just not a risk I would ever want to take in a class like this. You guys are paying too much, and there's too much effort and time and energy that's going into these different classes to ever, put yourself at risk of not passing the class. And I'll do anything I can to give you enough points to pass the class, but I got to see sufficient effort to make that happen. I can't just wave my wand and give you extra points because I'm a nice guy. I wish I could sometimes, but I've got to see the effort sufficient for the score that I give. Okay. and I try to be as fair as I can about that. Speaking of that, as far as grading is concerned, you'll have all your grades from the prior week by Tuesday at noon of the following week, which is about a day early from as far as course policy is concerned, school policy is concerned. But you'll notice that I grade everything at the same time and about this in a kind of the similar pattern. So sometimes on a Sunday night or a Monday night, I'll grade everybody and everything in the class. And it's because I like to look at everything in a similar time frame so that I can be more equitable as far as the scores. There's some subjectivity to scoring. You all know that, right? This isn't a math class where everything's right or wrong and that's just it. This is more subjective. You're writing a paper. You're giving opinions on a discussion board. Those things are subjective. So I need to be more consistent in how I grade. I need to see, more assignments and more discussion boards all at once so that I can be more equitable in how I do it. Okay. So, but everything will get graded from the previous week if it's turned in on time by Tuesday at noon. And you'll have some feedback. One of the things that I'll give you as far as feedback on the discussion board and assignments is an opportunity to correct work or to add or edit what you've done. And I will give additional points if you're willing to resubmit or willing to add or edit, your posts. No guarantees on how much extra, additional credit you'll get. No guarantees that you'll even get close to what the original score total was. But I will give you additional points if you'll put in additional effort and I see it moving in the right direction. Okay? So again, no extra credit other than what you can do on the checkpoints, getting that extra credit. But also I give the opportunity to resubmit assignments and discussion boards posts or add or edit discussion board posts for additional credit. All right, I think that's all. Of course, we have a test every week. This first test is only 10 questions. The test is only worth 50 points, which is still a half a letter grade again. So it's not, no slouch, but all multiple choice. And we'll spend the last couple of minutes every single class going over what's going to be on the test. I'll be giving you the topics, the specific topics every single week during the session that you need to know. And what I would suggest that you do is take a few notes on those topics and then do some more purposeful reading and studying when it comes to the text, right? Instead of just reading it straight through and trying to memorize everything or trying to remember everything that you learned, what I would do is I would take notes from the session on what is going to be on the test, and then I would be more purposeful about how I study, looking for those keywords and subjects that are going to be on the test and reading about those, making sure that you really understand those concepts before you get to the test. It'll make the test much easier, much less stressful. They'll go faster. I just can't say enough about how important I think it is to do some studying that's purposeful based on what we talk about in the session. But that's what we'll do for the last few minutes. What we'll do every session is we will go over the chapters. There's some slides on every chapter. We're not going to be able to cover all the slides. The slides are very verbose. There's a lot of them. I'll cover some high points or maybe sometimes just go through as many slides as we can get through before the end of the class. You'll notice that I speak fairly fast. Sometimes I'll slow down, but most of the time I'm going fairly quickly. If you need to listen or re-listen to something, that's fine. I'd rather have that than everybody be bored by how slow I go. So I'd rather go quickly if it's okay with all of you. If some of you need me to slow down, let me know. Just zip me a quick email. Speaking of zipping me a quick email, as far as communication, I do have a day job. I work for Zions Bank as an investment advisor. I think I mentioned that. But I'm not able to take calls usually during the day. I can, however, respond to a text or an email within, very short period of time. So if you are able, to text or email me, I would prefer that as far as communication here in the course. We do have a learning coach. I've posted her information already. You're welcome to find her in her lab or just reach out to her individually to get help. And I would encourage you to do that if you're struggling with anything or just feel like a little bit extra help would be good. Okay, I think we've covered some basics as far as expectations. We've covered kind of grading. We've covered extra credit or the lack thereof. We've covered resubmissions. We've covered late work. We've covered basic expectations for the assignments and assessments each week, discussion boards, checkpoints. I think we've got all the basic expectations out there. Any of you who are listening to this at a later time, if you've got any additional, questions that you have, please just zip me a quick email, let me know. By the way, tomorrow's Halloween. This last weekend, Stranger Things 2 was released. We've got the World Series going on. We've got basketball season starting. We're in the middle of the NFL season. It's a busy, busy time. I realize and recognize that. So one of the things that I always mention is that I don't expect many of you will be able, especially on the first night of a course, will be able to join me for a live session. I really appreciate when people do. But I also understand that, it's not going to be something that many of you can do, balancing your work life and family life and all the other things that you have going on. Having said that, the school policy is, and the expectation is, that you will review each week's session. And so I will try to fill the sessions with interesting information, with good information, good feedback, things that you can learn, and direction, most importantly, for the coursework that week. This is how you pass the test this week. This is the information that you need to know for the assignment. This is the thing to look out for the assignment and the discussion board. Those kinds of things I think are very, very important. But also, just at a bare minimum, the school does expect that you will review the recorded session at some point. And like I say, if for nothing else, just to make sure, if it were me, I would make sure that I've got notes for the test each week. I hear very often people giving me feedback that the tests are the things that cause them the most anxiety in these courses, on these online classes. And it may not be you, but for those of you who do feel anxiety about tests, I will say that the most important thing about trying to reduce anxiety for a test is knowing or feeling like you know the material and know the material that will be tested on, right? A lot of the anxiety that we have about tests is that we don't know for sure what the test is going to be about, what the test questions are going to be. I'm telling you that every single session I will tell you the specific topics that you will need to know for the test, and hopefully that can reduce anxiety and get you better prepared to do well each week and be successful. Okay? All right. So those are expectations. That's the course in a nutshell. That's how you are going to be successful if you want to be in a class like this. What we're going to do next is go through some of the slides on investing. And then if we can get through some slides, we'll spend the last, like I say, 3, 4, 5 minutes talking about the 10 questions that will be on the test, the topics that you will need to know for the test this week. Okay? All right, so let me get to the slides. Excuse me for just a sec. All right. Looking through here. Okay. So chapter 12, chapter 13, these are 2 chapters in the book on investing. One of them is about stocks and bonds. One of them is about mutual funds and ETFs. And we're going to talk about stocks and bonds just briefly because they are the cornerstone of most other investments. So when we talk about mutual funds and ETFs, or exchange traded funds, we're talking about funds that aggregate, or that pool, maybe a better word for it, they pool various stocks or bonds. So when we talk about a mutual fund, a stock mutual fund, we're just talking about a mutual fund that invests in stocks. When we talk about an international growth stock mutual fund, we're talking about a mutual fund that pools different international growth companies. Okay? So when we talk about stocks and bonds, it's important for us to understand what at the core we're talking about. When we talk about a stock, we're talking about equity in a company. We're talking about ownership in a company. There used to be a commercial from E-Trade years ago that I thought was great. It was these guys standing around, just these normal folks, right? It would go on to them, and then there'd be a quick video of them saying basically, I am the owner, or I am an owner in Microsoft, or I'm an owner in Walmart, or I'm an owner in McDonald's. And they would say it kind of like they're, really important, right? Well, reality is anybody who owns stock in any company is an owner of that company, albeit a very, very, very small owner in that company, right? So small that we don't really have much power, right, when we're an average investor. Now, somebody like Warren Buffett, who invests billions of dollars in certain companies like American Express, Wells Fargo, there's a list that's pretty long now of different companies that he owns billions of dollars in those companies, if not hundreds of millions of dollars in those companies. And those companies do have to respond and respect his wishes. It's not that he controls them. It's not that he's a puppeteer and they have to do whatever he says, but he does have power. He does have power to vote. Vote on mergers, acquisitions, vote on new board of directors, vote on new, which the board of directors then controls the executives of the company. So there is some power to be had as a stock owner of a company. That is the actual ownership of that company. So when we say who owns that company, who owns Microsoft, the stockholders do. not the CEO, not the management. The stockholders own Microsoft. The stockholders own Apple. The stockholders own Google. They're the people, whoever owns the stocks, that actually own the company. Okay, so that's why we call it equity, or another word for equity is ownership. So an equity is stock. It's another synonymous, it's a word that's synonymous with equity is stock. Okay, so if I'm a stockholder, I'm an equity holder in that company. I'm an owner in that company. So why do stocks go up and down so much, even for companies that are really kind of stable, like Walmart or Amazon or McDonald's? The answer is because people are buying and selling those stocks every single day and pushing the price up or down, not always dependent on how well the company's doing. So, for example, today the market was down. McDonald's might be having a great year. They could be having record sales, and their stock might have gone down today because the market overall went down. That's called market risk. And so you have some risks associated with stocks that don't just involve the company itself. Most of the risk associated with the company or the stock is the company, but a lot of the risk just has to do with the ups and downs of the market and other issues that are occurring around stock investing. So, okay, so that's what stocks are. They're ownership or equity ownership in a company. What are bonds? Bonds are the debt of companies. Okay, so when we talk about a bond, we're talking about a promise between two entities, one that lets another entity borrow the money, and the other saying, okay, if you let me borrow the money, then I'm going to pay you back with interest over time. That's what companies are saying. So when Walmart wants to open 200 new stores in China within a very short period of time, they don't have the billions and billions and billions of dollars that's necessary, theoretically, and this is just an example, to be able to build all those stores as quickly as they'd like to. So what do? Well, they could either go to a bank and ask them for a lot of money, and most banks would say, we don't want to lend that much. Or they could go to the bond market and have investors invest in their bonds, or in other words, invest in their ability to repay over time with interest. Okay, so what do we get in return for investing in somebody's debt or in somebody's bond? It's the same reason that banks are in the business of lending money. They're going to get back their money plus interest, right? That's the reason that they lend money. The same thing is true for bonds. The reason people invest in bonds is because we're going to get our money back over time with interest. Somebody's going to pay us for our money over time. They're going to pay us a dividend, or they're going to pay us interest. Okay, that's what a bond is a promise between two entities. In this case, if it's a corporate bond, it's between the investor and the company itself. The company's promising to pay back over time with interest, and the investor's the one that's putting up the money. Okay, so that's what a bond is. You have bonds from all kinds of different companies. You have bonds from governments, municipalities, cities, states, all kinds of entities will bond. What that means is that they will allow for investors to invest in whatever they're doing, and in return, they'll pay them back with interest over time. Okay. That is the basis for almost all other investing. So when we talk about exchange-traded mutual funds, we talk about variable annuities with investments inside of them. We talk about all kinds of other investments. We're talking about usually at the core either equity ownership or debt. Okay, either stocks or bonds at the core. And then, of course, we create all kinds of other financial products based on stocks and bonds. Okay, so that's chapter 12. We're talking about stocks and bonds. A couple things we want to look at here real quick, and then we're going to get to 13 and spend some more time in 13 on exchange-traded funds and mutual funds. Okay, so one of the things that the book wants to make very clear is that when it comes to investing, there are a lot of risks. Now, if you've ever invested in a mutual fund or a stock through an investment company, so for example, when somebody invests in mutual funds through me as an investment advisor with Zions Bank, they are going to get a lot of disclosures and paperwork in the mail. And sometimes people don't want to see all these disclosures and paperwork, but it's absolutely necessary for us to send them out. The issue is we have to disclose all the risks associated with an investment. That's just the law. And so sometimes you'll get a 30 or 40-page booklet, okay, like a little book with very small print, obviously written by attorneys, about all the different risks associated with the investment that you just made. And sometimes it's kind of scary, right? That's a lot of information about potential risks that it could have. But a lot of those risks, they have to be disclosed. And if you read about them, you'd say, oh, yeah, of course. So if you invest in a stock in a company or a bond in a company, you're taking on some business risk, right? The risk that that business is going to stay in business. You're taking on some financial risk, right? They have their finances, their asset sheet, their balance sheet, their balance sheet, their income statement. These are those different financial statements that you've learned about in corporate finance classes. All those elements of their financial statements have financial risk, right? If they have too much debt, if they don't have enough income, if they have to pay too much interest, if they don't have enough sales, if they don't have enough revenue, or they have too high of expenses, all these kinds of things are financial risk associated with the business. Then there's market risk, and we alluded to this before. This is the risk of the overall market going up and down. And many companies, the biggest risk to fluctuation of their company is market risk. So many big companies like Walmart, for example, will go up and down almost lockstep with what the market does, right? So if the market goes up, Walmart stock goes up. If the market goes down, Walmart stock goes down. Every once in a while, Walmart will come out with some kind of press release or information that will have them move a different direction. But almost always, these big company, mega companies, will actually move, generally speaking, the same direction as the market. That's market risk, because the market can go down, right? If everybody decided overnight that everybody was pessimistic about Donald Trump, or about the fact that tax legislation is not going to go through, or about how North Korea is going to start throwing nuclear weapons around, that can affect everybody's stocks, even though the companies underneath aren't struggling. It's a market risk when there's bad news or headlines in the world. Okay. And then some other risks associated with investing we're not going to talk specifically about, but pretty straightforward. So what do we get from investing? Why the heck do we invest? If there's all these risks, what are we investing for? The reason we're investing is because we're trying to get some kind of return. And how do we calculate return? There's two different aspects of return when it comes to bonds and stocks. One aspect of the return is the income that we'll receive, and the other aspect is the value change that we'll potentially receive. Okay, and in the case of both bonds and stocks, there's a potential for income. With stocks, they have what's called dividends that they pay, usually on a quarterly basis. With bonds, they have an interest payment, or a coupon payment is what we call it when it comes, technically, when it comes to bonds. So both of them have the potential to pay us income. Okay, that's one reason we might invest, because even though there are those risks, we want the income. Secondly, though, there's also what's called value fluctuation. And with a stock, that could be substantial. A stock could go way up or it could go way down, just depending on how that company did or how the market's doing. With a bond, it tends to be considered more conservative, doesn't go wildly up or wildly down, as dramatic. There's not as much motion as there is in stock investing. And in large part, the reason for that is twofold. One is that when a company fails, bondholders are the first ones in line to get paid. Stockholders are the last ones in the line to get paid. So if a company's really struggling, the stock will go down very quickly, and bonds tend to not go down as quickly. Although if a company goes into bankruptcy, neither the bondholder or the stockholder might get paid. Okay, they might both go to zero. But it's less likely that the bondholder will go to zero than it is that the stockholder will go to zero, and that's why stocks, by design, are a little bit more volatile. They're also more volatile because you're dealing with a position that usually is not as focused on income as bonds are. Bonds are more focused on income, and because they are, even if the values don't change a lot, people are patient and they just keep collecting their income, right? But with stocks, people expect returns from stocks. And if all stocks are doing is just paying their dividend and then going sideways in value, people will sell those off. And so stocks have a lot more pressure for growth in value. Bonds have a lot more pressure for a return in income. But both of them can change in value, and both of them can change in income as well, as far as the total return. When we're calculating a return on investments, though, we should always be calculating both the return of the income received and the value change, right? There's the potential to have an income received and a value change downward that offset one another to where you don't get any total return from that investment. There's also a chance that you might have some income but significant value change downward and lose money. Okay? So there's different scenarios where you're trying to add up the income and the value change to get to your total return for a period. Now, when it comes to investing, and we talked about this in terms of the discussion board this week, and we won't go into depth here because it's just a really important concept that you need to think through beyond just a session like this. But the risk-return trade-off is real, and it's significant, and it's so important when it comes to investing. A lot of people would save themselves a lot of heartache and headache and pain when it comes to their finances if they would just consider that in a normal investing environment, the more risk you take, the more potential for return there should be. And the less risk you take, the less potential for return there should be. So if somebody comes to you and gives you an opportunity to invest with them, and there is supposedly very low risk in this investment, yet they're paying 3 or 4 times what the stock market is going to get, say they're telling you could triple or quadruple your money over the next few years, where the stock market, on average gets about an 8% return a year. If you're getting triple returns in 3 years or 2 years, then we're probably talking about something that has to take a substantial amount of risk to outpace the market that fast. Because if it wasn't taking a substantial amount of risk, if it truly was really, really conservative, then they would not have to pay or not have to return such high returns. Let me give you an example of this. I work at a bank, right, and help people with investments. People come in all the time and say, hey, what are your CD rates? And we say, okay, here's the CD rate. Right now, they're horrible, right? Maybe you'll get like 1.4% for a year, which the average over the past 30 years is closer to 3%, but right now it's at 1.4. So then somebody says, oh, geez, that's terrible. I don't want 1.4. I was hoping for more like 5. We say, okay, well, there are investments out there. There are bonds and there are different stock and bond portfolios that could get 5%. They can target 5% returns. But what you have to understand is if you're targeting a 5% return, even though you might be conservative in the sense of stocks and bonds that are conservative, still, it's much more aggressive. It's a much more aggressive account with much more risk than your CD, right? So if a CD is paying 1.4 and you're targeting an account that has a target of a 5% return, there's got to be a risk-return trade-off or that wouldn't happen that way. So you must be taking additional risk. Now, it's not bad to take additional risk. We just need to always understand what that additional risk is, right? And we also need to analyze, because in some situations, we might be taking risk and not getting additional return for it. So we might be investing with our Aunt Maria, and she might be paying us a 5% return on our money that we let her borrow. And frankly, Aunt Maria's little bakery that she's got is probably a pretty high risk. It could close up any day, or if something happened to Maria, then we might not get any of our investment back. But if we're only getting on par with a very conservative portfolio in the market, there's something wrong with our risk-return trade-off, right? We want to be as efficient as we possibly can with this risk return. We don't want to take any additional risk that we don't have to get to our target return. And likewise, we don't want to get a return that we don't understand the risk on. So 2 things that we always need to be considering with the risk return trade-off. One is we want to find out what the target return is for the portfolio that we have or the investments that we have. And everybody say, well, it's just the highest amount I possibly can get. And what I would say to that is, if you know the risk return trade-off, you would not you're not always just trying to chase the highest returns you possibly can find, because you would understand that you're assuming additional risk to get that extra return. So do some financial planning, figure out what kind of return you need to get, if it's 7, 8, 9, 10%, and then build a portfolio that maximizes the return for the amount of risk that you're taking to get to your target. But don't take an ounce of additional risk beyond what you absolutely have to, because that doesn't make sense. There's no logic to taking additional risk than what you need to get the return that you're hoping for. So a lot of times we'll be analyzing somebody's portfolio and they'll be taking a lot of risk, but the return that they get isn't commensurate for the risk that they're taking. And that's what we would call an inefficient portfolio, right? They're taking extra risk and not getting return for it. So it's always important to consider risk return. This is just an interesting chart on risk. One of the reasons I really like this risk chart is if you listen to daytime talk radio, sometimes you'll get caught in thinking that commodities are precious metals, which are on the furthest of the risk pendulum, right? See them up at the very top right. This is gold, silver, precious metals. This is oil and gas, those kinds of things. Those are all up on the top right. That means there's good potential for return, but there is also significant potential for risk, right? And so people will say, hey, gold is a safe investment, or they'll say oil and gas is a safe investment. And I'll say, yeah, there are times when they can be a good diversifier. It might be nice to have some of them for diversification purposes, but I would not call either of those a safe investment. They can be a good long-term investment, a good diversifier, but they are definitely not a safe conservative investment. They're a more aggressive investment, actually. They have very large cycles and swings. Just as an example, gold is down by about a third of what it was just about a year and a half ago. So you've lost almost 30% of your value if you invested in gold about a year and a half ago. Silver hit a peak of $45 an ounce just about a year and a half ago, and it's at about $16, just under $17 an ounce right now. So do the math on that. If you would have bought silver at $45 an ounce and now you're at 17, you got crushed. That's a horrible return. Now, will it recover? Probably, but it might take you a very long time to recover that. So the idea is there's this risk-return pendulum, and here is kind of your short list of how that works. Now, you could put a savings account right at 0 because there's no risk and very little return on a savings account these days, and then you can kind of go up this pendulum based on what your appetite for risk is and what kind of reward or return you're trying to get. So what makes a good investment? What's a good investment versus a bad investment? Obviously, a bad investment is one where you lose money over the long term, right? But when you're looking at different options and they're all good, right? They might be good alternatives as far as different investment options that you have. You want to look at future return based on history, what you expect going forward, but also what it's done historically. You'll want to look at income or approximate yield. That's another way of saying it. What it distributes as far as dividends or income, and what is your desired rate of return. Like I say, we establish the risk that you're going to take based on your desired rate of return. So we talked about what common stocks are. We talked about dividends. And then this will talk about bonds in a little bit. Okay? But that's all we're going to do as far as the stocks and bonds investing slides for tonight. So let me get out of this. I want to make sure we have a little bit of time on the investments page. Okay, so hopefully you can all see on your screen investing in mutual funds, exchange traded funds, and real estate. We're not going to talk about real estate tonight. What I find actually is very consistently in classes like this, many people have had experience with investing in real estate. It's much more common for people to say that they've had experience or someone that they know has had experience in real estate than it is for them to understand the principles associated with stocks, bonds, and mutual funds. Okay, so we're going to talk a little bit about mutual funds and ETFs. We don't have a lot of time. We've got about 10 more minutes before we need to transition to talking about the test this week, the assessment. But I do want to give you kind of a background or some foundation principles on mutual funds and exchange traded funds or ETFs. Exchange traded funds or ETFs are becoming the most popular form of investing that's available. Now, mutual funds are still dominant because they've had a lot more years. They've had about 80 years of history in mutual funds, and ETFs have only had about 15, 20 years and really have only come into really becoming very much more popular in the past 5 to 10 years. Okay, so they're kind of newer to the game, where mutual funds have been around for a long time. Also, within most people's 401ks, which is where the majority of investing takes place in the United States, happens, at least as far as retail investors are concerned, it happens within mutual funds. The reason for that is because of 401ks. Most 401ks, the option that you have within that 401k is a selection of different mutual funds. Now, that is changing. Most IRAs and mutual funds now are transitioning to offer ETFs. So there's a lot more similarities between ETFs and mutual funds than there are differences, but the bottom line is both of them pool either stocks, bonds, or stocks and bonds together. Okay, so you can have a mixture of stocks and bonds within one fund. It's called an asset allocation fund, or you can have just a pure play, certain kind of bond, certain kind of stock fund. Okay, so some names that you might be familiar with from an IRA or 401k or investing that you've done in the past might be something like small cap growth. Okay, you think, what the heck is that? Well, small cap just is related to the capitalization of the company, how much money the company is actually worth. So it's small, then it's a smaller company, right? And growth, it's growth focused. So small cap growth is a small company that's focused on growth, and it's a stock fund, right? Or you might have a fund that says high yield, and high yield is referring usually to a bond fund that focuses on lower quality bonds that pay higher interest rates. Okay, so that's a high yield fund. So there's all kinds of different names and different terminology for different categories of investing, but all of them basically are different categories that you can invest in through mutual funds. There are over 7,000 different mutual funds out there, and almost as many ETFs coming into existence, and there are more ETFs coming into existence every day because they're so popular, as I mentioned before. So what are these mutual funds and ETFs doing? Well, they're providing us, pooled diversification, basically. So the idea is, I, as an investor, look at the stock market. I say, oh, geez, this is overwhelming. There's too many different companies. I don't want to pick just one, because what if I pick Tesla, and Tesla looks awesome right now? Well, what if the new Model 3, if a bunch of people die in the Model 3 because it's not safe, and there becomes a huge class action lawsuit for over billions of dollars, and overnight Elon Musk goes bankrupt and Tesla no longer exists? Okay, so that's a stretch. That's a wild, right? That probably is unlikely, but it is a possibility, right? And I don't want to be the one Tesla investor that put all my money, everything I owned into that one stock, and then I don't have anything to show for it, and I lose everything, right? Well, a way that I can avoid that is I can say, okay, how about instead of that, I invest in what's called a technology mutual fund company. And that technology mutual fund company is probably going to invest in Tesla, among other companies. Okay, they'll invest in a lot of different technology companies. Then if one of those companies goes out of business, it doesn't have a material impact on my fund, and on my money. But I'm still getting the upside and potential from Tesla, just at a watered down, at a watered down level. So individual stock investing can be more exciting, both from an upside and downside perspective, right? Mutual fund investing tends to be less exciting, more diversified, and more predictable. Okay, so there's a collective benefit. There's also the issue of if I have $100 and I want to invest in the market, I'm not going to be able to buy very many different stocks. Okay, average stock price might be like $25, $30, so I might be able to buy 3 shares, maybe 3 different stocks or 3 different companies with my $100. And each one of those buys, by the way, in each one of those stocks has a transactional price, maybe $5, $10, right? Each time I transact into those stocks. If I buy a mutual fund for $100, I could buy a mutual fund that owns 200 different stocks inside of it with my $100. So I'm highly diversified with just $100. Plus, there probably isn't any transactional charge for me to doing it. So the $100 that I put into the mutual fund is still in the mutual fund. I've got $100 to show for it, invested. Where if I would have done the stocks, I would have paid the transactional fees and maybe had a lot less than what I started with, right? I might have just $60 or $70 invested instead of $100. So mutual funds allow me to be diversified. They allow me to have economies of scale, put smaller amounts in, and be highly diversified. They also have professional money managers, so I might be overwhelmed by what I should pick or how I should pick. Well, mutual fund managers, and especially large funds, will have a team of folks, team of analysts that their full-time job is to pick good stocks inside of a fund. And so, not that that's foolproof, they're making their best educated guess, but mutual funds, as a general rule, will outperform the average individual investor in their own, with left to their own devices over time. And we've got statistics that show that over 20 and 30-year periods of time, average individual investors do about 6% less than what the stock market's average. So they average about 2.3%. The stock market's average more like 8.5%. But the average investor's gotten so much more poor returns because they make poor decisions. Not because they make necessarily all the wrong choices as far as who to invest in, but sometimes it's the wrong choices about when, right? When to get in, when to get out. Those kinds of decisions are critical as well. Returns tend to be decent in funds if they stick around, and they're very, very convenient to use. That's why 401ks and IRAs are, that's why they use them so exclusively. So there's open-end and closed-end investment companies, but I'm not going to go over that because open-end companies are mutual funds, and they're the most common ones. So let's talk quickly about ETFs and why, not EFTs, but ETFs. The slide is wrong. It's fun that the publishing company couldn't get that right. But anyway, the point is ETFs, exchange-traded funds, are very common, very popular right now. Like I say, newer. Even though they've been around for 10, 15 years, they're newer to the scene, but they're collecting a lot more incoming flows than any other type of investing right now. Why is that? Because they're basically taking the concept of a mutual fund and stripping out a lot of the fees and costs associated with a mutual fund. And of course, anytime you strip out a lot of the costs and fees, you make that fund theoretically more efficient, and we make more money. right? So if I can look at an ETF over the past 10 years and compare it to my average mutual fund in my account, and the ETF did better because of costs, obviously that will start to build some momentum, for ETFs. And ETFs generally have much lower costs. Now, most ETFs are not managed, meaning most ETFs are an unmanaged basket of stocks, more like an index fund. Okay, index funds were never managed. What they were was they were a computer-generated portfolio of different stocks, bonds, or stocks and bonds, right? And so there was no active manager making decisions. It was just, here, we're going to put this basket together of different investments and let it go, let it ride. And of course, that's why it could be a lot less expensive to manage it, because there's nobody having to actively make decisions for the fund. Well, historically, these index funds have done very well. And companies like Vanguard would say and market to the fact that, hey, if you keep your expenses really low by using an index fund, you'll actually do better most times than the active managers that are out there. And in fact, Warren Buffett made a famous bet 10 years ago against a big hedge fund. Actually, he went out and basically said, any hedge fund manager that's out there, I'll bet you $1 million over the next 10 years that an index fund will beat out your hedge fund. Okay, so hedge funds are usually a very costly way of investing. Sometimes they're highly successful, but a lot of times they're not. And so basically what Warren Buffett was saying is, for the average investor, it's much better for them to use indexes and actually put his money where his mouth was and said, I'll bet you $1 million over 10 years, which $1 million to Buffett isn't worth very much. He's worth billions and billions, right? But $1 million is still a lot of money nonetheless. And he basically went out in public and said, hey, any money manager that's out there, any actively managed fund manager that's out there, I will bet you, if you're willing to step up and make the bet, $1 million over the next 10 years that the index fund, just an S&P 500 index fund, will beat your returns. Only one money manager took him up on it, and that one money manager owes him $1 million. He lost the bet by a long ways. Index funds can be a very efficient way, again, because they're so low cost to investing. They basically take categories like the S&P 500 or the financial services category or small company category or China. They just invest in a basket of stocks in China. And instead of having an active manager, they just put a basket together of these different stocks and they let it go. They let it do what it's going to do over time. And a lot of times it does quite well. So that's why index funds were kind of the start to what is the modern day ETF, and exchange traded funds, like I say, are at this point the most popular flows as far as new investing is concerned here in the United States. Okay, there's lots of different cost considerations when it comes to mutual funds you should be aware of. That'll help make you a more educated investor when it comes to your own investing within an IRA, with an agent. A lot of people think that they're getting their mutual funds or they're investing for free. The reality is, of course, no one is in this business for free. There are always management costs and fees associated with your mutual funds. So if you don't understand what those fees are, it might make sense to do some research and figure that out. Okay? All right, that's all we have time for. So let me spend a few minutes talking about the topic areas of the test. Pull it up here real quick. If I can get my password right. Okay, so for the test this week, there are 10 different questions. I mentioned that before. They're all multiple choice. They're not hard. They're pretty straightforward. If you've reviewed the material, you should be in great shape. But here are the actual topics that you need to know. The first topic on the test is talking about stocks, and basically it says, tell us the name or category of stocks that are usually stable, older companies. Stocks that are stable, older companies. What is the terminology for stable, older companies? It's a certain type of stock investing. Okay, so that's number one on the test. If you know the definition of the stable, old investments, older companies, you'll get that number one right on the test. Number two on the test, you'll need to understand what the PE ratio or the price over earnings ratio means. Okay, what does it mean to have a higher PE ratio? What does it mean to have a lower PE ratio? I'll tell you that higher PE ratio companies are usually considered high growth companies, and lower PE ratio companies are considered lower growth companies. But it also depends on the category or type of company that they are. Generally speaking, banks will have lower PEs than, say, for example, tech companies. And generally speaking, tech companies grow faster than banks do, right? So just understand the basics of why a PE ratio is high or low when it comes to stocks. Okay, because PE ratio is one of the most important ratios we look at when we're trying to value where a stock's at. And so price over earnings, the price of the stock over earnings, is how we get to that PE ratio. And that's how you can do a quick valuation of whether or not a stock is highly priced or low priced. Number 3 on the test, understand the difference between taxation of a cash dividend versus a stock dividend. These are two different ways that stock, when I own a stock, I can receive my dividend. I can either get more stock or I can receive cash. Are they taxable or are they not? That's for number 3. Number 4 on the test, you'll want to know this is a really, it's kind of a weird question, but basically corporate bonds are usually valued in a certain issuance amount, okay? Like $100, $2,000, $1,000, $1. Are they issued in what face amount? Okay? Just know that before you get to the test. Corporate bonds are usually valued in what face amount? Number 5 on the test, we talked about different risks, right? We talked about business risk, financial risk, market risk, purchasing power risk. Just make sure you understand the definition of those different risks before you get to the test, because both 5, 6, and 7 are all about those risks. So if you know the definition of those risks and can base, you don't need to memorize the details on them, but just if you can know the differences, the key differences between those different risks, you'll get 5, 6, 7 on the test right, because they're all having to do with you being able to identify different risks associated with investing. Number 8 on the test, what are the advantages of mutual funds? If you just know the basics of why there are advantages to mutual funds. There was a screen earlier on tonight that talks about why mutual funds. And right here. So just make sure you understand those concepts and you'll get number 8 right on the test. Number 9 on the test, you'll want to know what the definition of net asset value is on a mutual fund. What is NAV? What is net asset value? If you understand that, you'll get number 9 right on the test. Number 10 on the test, you have value stocks and you have growth stocks. Make sure you understand before you get to the test which one of those two is more likely to pay high dividends. Which one of those is more likely to pay high dividends, growth stocks or value stocks? Okay. And by extension, a growth stock mutual fund will usually have high dividends or low dividends. Okay. And you'll be able to understand that because a mutual fund is just an extension of whatever's inside of it, right? So how we price what a mutual fund's price or benefit is based on how well the stocks or bonds inside of it do. Well, if I have high growth stocks inside of a mutual fund, that will determine whether or not I get high income or low income on my mutual fund, okay? And remember, there are two different ways to get return, right? One of them's value change and one of them's income. So somebody who's focused on income will go to certain mutual funds, and somebody who's focused on growth will go to different mutual funds, okay? All right, so those are the 10 different segments or topics on the test this week. If you have any questions as you review tonight's session about the test questions, let me know before you get to the test. I'd be happy to review that with you. And have a great week. I hope it's a great week. I hope you have a good holiday tomorrow. Hope you all have enjoyed Stranger Things 2 that just got released last weekend. I've been binge watching a little bit of that. And yeah, have a great week. Let me know if you have any questions, and we'll talk to you soon. Thanks. Have a good night.